I was so wrong, going over my predictions for 2023. So near the start of 2023, I made a video that went over my predictions for the upcoming year. Well, guess what? Your boy was quite wrong with all of that, but I'm not going to hide and cower. I'll admit defeat. At the very least, it was one of my lesser performing videos for the time, so who knows how many people watched it. I know at least one person bought based on my suggestions. I'll justify myself, and if it makes you feel any better, I too put my own money where my mouth is. But that particular stock had something happen to it that I couldn't predict at the start of the year, so I'll explain myself, but we'll get to that when we get to that. But first, I'll show some snippets from some other finance channels that admit they were also wrong about a few things, just so you guys know that I'm not a total dunce and have no clue what I'm talking about.
A year ago about what my predictions were for 2023. And although some were right, there were plenty that were also wrong. And the ones that I was wrong on, apart from the fact that I thought interest rates would actually cut in 2023, was that I totally undersold what the numbers could look like when it came to growth. I knew that we had a rental crisis and I knew that there was going to be a supply crunch because we had more people coming into the country, but I totally undersold how much the property market would grow. 6 rate cuts in 2024. So although I was wrong about rate cuts in 23, I'm telling you now in 24 we should see those interest rates cut, but they will happen sooner than we expect.
Rises are starting to bite. Australian house prices are tumbling at their fastest rate on record.
What do you see? Doom and gloom just about everywhere you look. The big 4 bank economists, wrong. Christopher Joy, wrong. The AFR, wrong. Wherever you look, wrong. In this video, I'm going to go through my 11 predictions about the Australian property market and lending markets in general that I released at the beginning of the year and revisit and see how I actually went against it. Guess what? I'm like all the others. I was wrong on many individual predictions. When you make 11 of them, specifically about the housing market, you're going to get some wrong. But on the broad scheme of things, I was definitely wrong about how the Australian property market would respond so resiliently to all these rate rises that we've had in 2023 alone and all the ones that we had in 2022.
There are growing fears more renters will face homelessness as up to half the state's landlords consider selling their investment properties.
Prediction number 5. This one I got wrong. First home buyer demand in New South Wales will rise on the back of incentives. $5 million max budget, so more people were pushed into that budget, but it wasn't on the back of incentives. So this one definitely got wrong. Prediction number 6. This one I still believe will happen, but I've got the timing wrong. APRA adjusts assessment buffers later in the year.
November last year. This is important because oil prices have fallen sharply in 2023 compared to 2022, and so gasoline prices have fallen too. This is nothing to do with demand or how the economy is doing, but excluding this oil price drop, the US economy is on a very strong path to recovery. And it's funny watching all the YouTube idiots completely change their tune, because this is what all of those clowns were saying exactly 1 year ago.
If I'm looking at 2023 as a whole year, I'm very pessimistic. I think a recession is not only unavoidable, it's going to be very violent. So I'm staying the hell away. I'm very careful from this market.
Right now, the government says down, we play down.
Based on this metric, is that the next 10 years is going to be very difficult to make money.
I am guessing that those clowns will go and delete those videos as soon as they see this one. I've put the links to those videos in the description just in case, but here is what I said at the same exact time. And I am not sure if I am looking at a completely different set of data to the rest of the world, or maybe panic and fear sells. You know, I'm guilty of making stupid thumbnails too. I'm so sorry. But let me tell you about the data, because the data is showing that the exact opposite of the doom and gloom that everyone is prophesizing tends to be a more likely scenario. made a return of 62% on stocks so far in 2023. That means for every dollar I had invested at the beginning of the year, I now have $1.62. And I don't talk about my portfolio very often at all on the channel. I checked, and I think I haven't made a single update this whole year. But seeing as I do talk a lot about investing, about personal finance, managing money, I wanted to share what I did this year to get my 62% return, what I currently hold in my portfolio, why I currently hold it, and most importantly, I want to talk about what I am going to do with my investments next year, because I feel next year could well be even better. Now, before I get started, I know there will be the obligatory comment saying, Sasha, you should have gone all in on Bitcoin because Bitcoin's up 150% this year. Or Sasha, if only you YOLO'd all in on Tesla, you would be up 135% this year. Or maybe if I still had a position in Palantir as I did 2 years ago, Palantir would be up 189% this year. And the answer to every one of those is I do not care. I don't care for two reasons. First, I am not here to get the perfect home run 200% return every single year, because that's not how the real world works. And I understand that. I also know that going all in on one stock is a very popular strategy here on YouTube with investing gurus who don't understand pretty much anything about how long-term investing dynamics work or why it's mathematically a really bad idea. And second, I prefer the low and slow approach because my investing horizon is longer than 3 seconds. And I'll tell you what, I am very happy with a 62% return. I use VTI as my benchmark. VTI is a full stock market index, and VTI is up 24% so far this year. So I've beaten my benchmark this year, but it's actually not all that impressive because my strategy relies on me beating the index when we have a good year, because I also tend to lose a lot to the index in a bad year like last year. Because I am an active investor and I pick my stocks, which is not a good idea. I tend to get an exaggerated version of what happens in the stock market. So this year, the stock market is up 24% overall, and I am up 62%. But last year, VTI was down 19.5% as the market crashed. I was down 47.3%. But actually, I did worse than losing just 47.3% last year because I was depositing money into investments throughout that year. And if you take the annualized version of my returns, it was minus 53.8%. And that's really pretty bad. I would need a return of over 100% just to get back to where I was at the beginning of 2022. So my strategy carries a whole lot of risk. It swings up and down, but I'm fine with it because I understand the risk. In 2021, just before the stock market started crashing, I started my public man versus the market portfolio. And this is what I said at the time. And I struck some lucky streaks, but the dark months are going to come. We're going to have market crashes, we're going to have stocks selling off, and all kinds of wild things happening. And I'm sure some of these are going to hit this portfolio really hard. So watch out for those, because those videos are going to be not quite as rosy as this one. And then the market will be laughing as the market is doing much better than I am. But so far, so good.
In all fairness, these are predictions at the start of the year based on the information at the time. This is the stock market. Obviously, a lot can happen throughout the span of a year. So I'm going to react to this 2023 predictions video, and I'll explain why stuff didn't pan out as I predicted. You'll find for the most part, I couldn't have predicted how things ended up turning out. I did make this video at the start of 2023 after all. A lot can happen in the markets in 12 months. But that doesn't change the fact I was wrong. It's like that South Park episode where Eric teaches these less privileged Latino kids. The student said he's cheating, but Cartman says the scoreboard shows 2-0 SA! 2-0! In this game of the stock market, it doesn't really matter how you play. All that matters is the results on the scoreboard. In this case, your portfolio's performance. I may be playing by what the rules say, but the referee doesn't care, and the opponent is playing dirty, such as the Bureau of Statistics botching their inflation data, which is something I'll go over later. Anyway, let's get reacting. And the reason I'm putting this on the record is because it'll be a test to see how well my overall knowledge of the whole investment and stock market thing is. And if by the end of 2023, what I've said is wrong, then I know what I need to tweak in my sort of investment journey. So I have tweaked my thesis, more bullish. Long story short, but I saw more evidence this year showing the market is a lot more decoupled from the economy, and most of my predictions were based around the economy, which is not indicative of the stock market's performance. So, after all I've seen this year, it tends to be a better idea to lean more bullish than bearish, regardless of what economic turmoil is occurring. But of course, keep an open mind and listen to both sides of the argument. I'll talk more about it in my next video, which will be my predictions for 2024, which might be a good watch for you guys based on this video. You might want to do the opposite of what I'm doing. Who knows? Now, inflation in the United States will end the year at around 5.1%. So the last reading it was 7.1%. There has been a drastic decrease in the M2 money supply recently, but due to a variety of factors, such as the recent move from the Bank of Japan, potentially increased demand from China, and everything going on with commodities, I think this will contribute to inflation staying a little bit higher than what some people think it will stay at, but the cost of a lot of things will decrease throughout the year, make no mistake, but inflation as a whole, I think it's going to end around 5.1%. Now, I could do the proper mathematical summary for calculating inflation, which is the quantity theory of money which I got from Steve Hanke and I think John Greenwood. But to be honest, I don't have time for that, and this is just a rough prediction, and obviously this is a prediction for the end of the year, so another 12 months from now, so there's a lot of factors that could change. So even if I did the proper calculation, I could essentially just be wasting my time because things throughout the year will change. Welp, this was wrong, but I drastically underestimated how much the Bureau of Statistics would cook the inflation data. In one of the most recent readings, they said the cost of healthcare insurance was down 35%, but ask anyone who actually had to buy it. No way did it go down 35%. So yes, I am wrong here, I'll own that, and it's my fault that I underestimated the government's ability to cook the data. I'll know better for next time. And especially if China does, I guess, reopen fully. I don't know about that, but if Chinese demand picks up, that's gonna, like Chinese demand for commodities picks up, then obviously that's good for Australian companies because we've got quite a few commodity-based companies here in Australia. So that'll increase the amount of sales they get, increases the amount of money they make, a la more money in circulation. Welp, this was also wrong. China's economy is way worse than I thought, so demand from China is low. So the demand for commodities is also low, which helps bring down inflation figures. And it's also bringing down oil prices, which I'll talk about later. Now, next prediction, inflation in Australia will end the year higher than what it is in the United States. So at the moment, I think it's neck and neck. For the whole year, United States inflation was higher than what it is here in Australia, but based on the RBA raising rates at a slower pace than the United States, coupled with some other more domestic Australian matters, I firmly believe that inflation here will end the year higher than it is in the United States. One such factor is our low unemployment rate. So the unemployment rate in the United States, from what I've seen at the moment, is quite low, but I'm pretty sure that is very botched data from what I've seen. But here in Australia, statistics aside, my anecdotal experiences show me that it's an employee's job market here. So this will just help contribute to higher wages overall, which means people are more likely to spend more, so inflation will persist. This was correct. The thesis was Australia's cash/interest rate is lower than the US, and we tend to lag 6-ish months behind the US economy anyway, whether that be via rate hikes, inflation figures, employment figures, etc. Now, speaking of the RBA and all that, I think Australia's cash rate will be around 4.1% around June. The reason I didn't say end of the year is because we could potentially get rate cuts here in Australia. There's speculation that Philip Lowe is going to be under immense pressure to cut rates because this economy sucks off housing like no tomorrow, and especially because all the politicians here have bucket loads of rental and investment properties that they want to just keep propped up. Obviously, these rate hikes aren't the best for those, so they're going to continually grill Philip Lowe, and they're going to keep using the trope of, oh, you're hurting first home buyers and the lower income earners and shit like that, without realizing that that's how you defeat inflation. So I think the RBA rates will peak around 4.1% around June. At the moment, at the time of recording, they're 3.1%. They'll have about 5-ish meetings until June. I reckon we'll get a 0.25 rate hike at 4 of them, and one of them will have no move, or we may have like 2 meetings with no moves, 2 meetings with 0.25 and 1 with 0.5. I don't know, but I just think we're going to have around 4.1% around June, and I think it may peak there. And I believe that's what the market is pricing in at the moment too, but that's 6 months away. A lot can change. Fuck, I'm good. I missed on the prediction about a rate cut, but that's because Philip Lowe got the boot. I was off by a 25 basis point hike, But I did say 4.1% around June, and I refrained from predicting what it would be at the end of the year. If I was as good at predicting the global economy as I was predicting the Australian economy, that'd be sweet. And I also said they had 5 meetings between the time of that video and June, and I also said 4 out of 5 of those meetings probably have a 25-point hike, with one having none. That's exactly what happened. And last general broad prediction, the stock market as a whole will continue to fall further. So, the market is calling the Fed dot plot a bluff. The Fed is calling the market's bluff. Don't fight the Fed. So, essentially the market is currently pricing in around a terminal Fed funds rate, which is the highest interest rate we will get before the Fed pauses raising rates or cuts it. But basically the market thinks that's going to be 4.6% at the moment, and the Fed is saying it's going to be around 5.1%. So the market is saying, oh, nah, the Fed, you're too chicken to raise them as high as 5.1%. And the Fed is saying, nah, market, you're wrong. You're way too high at the moment. You should be a lot lower because you're only pricing in 4.6%, not 5.1% like we are going to do. So the Fed has been bluffing in the past, but this time I don't think they are. So once the market realizes that, we are headed down further in the stock market. So for the longest time, I heard rule number 1 is don't fight the Fed, but the market fought the Fed and the market won. So lesson learned, sometimes fight the Fed. Although I guess the market called the Fed's bluff by saying, you're going to cut rates despite the Fed saying higher for longer. So on one hand, the market fought the Fed, but on the other hand, they called the Fed's bluff. Either way, Fed is likely to print some more money next year. We have this, and we will also have earnings compressions. So at the moment, the expectations for a lot of companies' earnings reports are a lot more generous than what I think will actually be reported. So when all these companies miss their earnings targets, the stocks of those companies will drop. And obviously, if those stocks drop, if most of them drop because they miss earnings, that will bring the stock market down as a whole, thus earnings compression. So at some point in the year, the analysts in the stock market downgraded their earnings expectations for many companies. They did this so companies can beat on earnings, which is good for their stock price, which means the Wall Street hedge fund managers can receive their bonuses for good performance, since the stocks they picked went up in value a lot, because they artificially lowered the stock expectations, which is fine with me. It's made the latest earnings season an easy feast for me. Now, this whole downgrade expectations, stock rallies, get your bonus, is one of the reasons why the market rallied, and it's also an oversimplification of what happened in the markets in this time. But the people who've actually worked on Wall Street will basically tell you the same thing. Gotta get your bonuses. So, as for the stock picks, so speaking of stocks, we may go into some specific predictions. Let's see how these pan out. So longs, which is stocks that I would buy, I'm not going to buy yet, if at all, because my trading's moved to more of a swing trader strategy. And like I said, I think we're going to get a lot lower in the market before we go up. But if my strategy had to be buy something at the start of the year, it would be DBO. Now, DBO is an oil fund. Currently, there are some headwinds to the price of oil, like basically headwinds are things that will stop the price of oil going higher. One such thing is a recession, which we are going to get. Obviously, oil isn't just for filling up your cars and stuff. It's used in the production of a lot of materials and used in a lot of services too. When a recession hits, the demand for all of this extra stuff is going to go down, which means those companies aren't going to need to produce as much stuff, which means their demand for oil will be down a bit lower. But then you've got also things such as the geopolitical tensions and the oil cap and the sanctions and all this other shit. So if I had to choose, I would imagine that this stock would be up by the end of the year. Like, it will close up. It will be a very bumpy ride, but I think it'll ultimately close up. But if it does close down for the year, I wouldn't really be surprised. DBO closed down for the year, which was wrong. This failed because the demand from China was nowhere near as good as I thought. Many of us expected China's economy to recover, but this is most certainly not the case, so this prediction flopped. OPEC has cut oil production, which generally raises prices, but the market is pricing in a recession, hence why oil prices are lower, since demand for oil is much lower in a recession. There has also been some recent tensions between other OPEC countries, like in December 2023 they had to postpone their meeting because they couldn't reach an agreement, and some African countries, for example, don't want to cut production because they need the revenue. There is speculation that countries like Saudi Arabia will flood the market with oil, which means the prices for oil plummet, which means the smaller producers can't compete, so they get weeded out of the market for oil, and once they're flushed out of the market, the Saudis will then slash production, meaning oil prices will rocket back up, but this time they won't have as many competitors for oil. But that's just some speculation through the grapevine amongst the commodities/stock market for now. Who knows if this will play out or not. So anyway, DBO is down because I didn't expect China's economy to be so shit. Now currently there's a war happening in the Red Sea, and long story short, the flow and effects of this can cause a spike in oil prices, but I'm not making any predictions now, since the stock market/commodities market/global politics can change overnight. So for now, I'm still keeping an eye on the oil market. Next up, LAC, Lithium Americas Corp. So with the transition to the green energy thing, you know, we all need electric vehicles and stuff. Lithium is a key component of batteries, which are going to be used for electric vehicles. And I have a feeling there's going to be more of a political push to that stuff in 2023. We've seen political pushes to that stuff in the, last few years, but I don't think they're going to try and go back to using coal or anything. They have in some other countries. I think Germany did it recently. Same with nuclear as well. I think Japan and Germany may have done something with that. Maybe some of the European country like the Netherlands, or maybe they're the ones who completely banned it when they shouldn't have. I'm not 100% sure on all the details, but my prediction is that Lithium Americas Corp will close up for the year of 2023. Now, the reason I choose this over the Lithium ETF LIT is because I held both of these in 2021, and Lithium Americas Corp drastically outperformed LIT, at least in the time I was holding it, which is why I've picked LAC over LIT. LAC closed down, so this company had some split, which I didn't foresee coming, and the demand for lithium was also down this year, as well as the price of lithium overall, which I also did not predict happening. Also, uranium started becoming a bigger thing this year, which stole some of the thunder from lithium, which is my bad, but how am I supposed to predict this? These recent videos shown here mention commodities. The video from Specialist Share Education, which is a channel I mentioned in this video, it's not in either of my finance channel videos since I found this after I made those, but anyway, he mentions how in February we will see lithium companies reporting, which means we can get a more accurate indication of lithium prices, since at the moment we can only check the spot price. There's a few reasons why the reporting from lithium companies in February gives more of an accurate reading to the price of lithium as opposed to the spot price, which is the price it's trading for in the open market, but it's basically because commodities prices can be manipulated, as we saw with nickel on the London Metal Exchange in the past couple of years, and we can see the prices lithium companies are working with. There was also some commodities info in that video from Stock Curry too, but the point is, I'm waiting for data to come out on lithium before making any more predictions, and this is also why you suss many different finance channels. You hunt for tidbits. No other channel I watched mentioned anything about lithium companies reporting in February. Now maybe this is because this channel is more Aussie focused, but that just means it's more relevant to me, especially since there aren't that many Aussie finance channels out there. And last one for my predictions for stocks that'll end the year up is KRBN. I think the proper name is the Crane Shares Global Carbon ETF. I'm not exactly sure off the top of my head, but Essentially, it's a carbon credits company. So there's been more of a renewed demand for that in the past few months from what I've seen. And essentially what this is it's a license to pollute. So in the future, what'll happen is with the whole green energy stuff going on, there are going to be some companies that need to use fossil fuels to produce the same amount of goods and services they were before, or the same amount to meet demand, whatever. There's simply not going to be enough energy they can derive from clean sources like wind, solar, water, stuff like that. So they're still going to need to use some fossil fuels to produce those goods and services. But the government will likely have regulated it a lot more or banned it outright by this point in time. This is years down the track, right? But what they will allow is companies will have to pay the government to use these fossil fuel sources, which is basically a carbon credit. A carbon credit is essentially a license to pollute. The companies will say, hey government, we need to use fossil fuels to produce these goods and services to keep our company going. We know it's kind of banned at the moment, but we'll pay you this amount so that we have a license to produce this stuff, / the government essentially just turns a blind eye in exchange for a fee, kind of like a bribe, but not really, but kind of. So that's essentially what a carbon credit is. There's a bit more to it, but that's very simply how it's put. So in that little explanation, I mentioned this was years down the track, but again, I have seen renewed demand for it. And there are some investors like me who are jumping onto this stuff, a bit early. But regardless, I think that this is going to close the year up. KRBN did nothing, so this carbon credits thing is kind of flopping right now. I expected it to slowly become a big thing in the future, but from what I've seen, this carbon credits thing is becoming less and less likely, so my bad. As for the short picks, as for shorts, or companies that I think will end the year down, if not completely go bankrupt, we're starting off with ARK. This is Cathie Wood's ETF. So she's become very delusional as of late, and I predict she will continue this delusion into 2023, and thus continue making bad investments such as, buying the dip in Teladoc or whatever innovative company that she has planned next. Another thing is the way that Cathie Wood's fund is structured. Every time an investor sells, that mutual fund, ARK, needs to sell off some stock to give money back to that investor, which causes further downward selling pressure on that mutual fund. So if you were to basically just buy every stock in Cathie Wood's ETF and just hold it, although it would go down, it wouldn't go down at the same rate as her mutual fund. So that's another thing that plays into the fact that I think this is going to close the year down even further. ARK, Jesus Christ, this was way off, but this is pumping alongside many meme / low market cap stocks. There isn't anything specifically this fund is doing that is revolutionary. It's just being pumped up alongside the rest of the market. A rising tide lifts all boats. Next up, Peloton, an electric bike / subscription company. Most gym rats will agree that this is a bad idea. I'll be surprised if this company isn't bankrupt by the end of 2023. So I wasn't in the whole investing space in 2020. I kind of was 2021, but it was more so just very general crypto bro shit. Nothing to do with the macroeconomy or anything. But from what I have seen, there was a lot of people pumping this particular stock thinking it was the future because gyms are shut. We're all going to be riding our bike indoors. If you're a gym rat, you know that this makes absolutely no sense. I myself have a home gym, but I prefer an actual gym because the atmosphere is just different. And, well, I don't know about you, but I've made a lot of friends through gym. What happens is you essentially go frequently enough at the same time because, you have work or something. Other people are on the same boat, and then eventually you just get talking, and then you make friends from there. I've met girls at the gym in the past, so if that's your thing, that floats your boat, that's fine. But you're not going to be making friends or meeting girls or meeting boys, whoever, using Peloton. I don't know if they have some subscription thing where I don't know if in their subscription thing you can like ride with other users or something like that, but obviously that's also not the same thing as going to an actual gym. And the most important thing of all is it's only a bike. It's not a full actual gym set. There's no barbells, dumbbells, resistance bands, cables, anything like that. So yeah, any gym rat will have known that this was a rubbish idea. I think Meet Kevin and Tom Nash were pumping this stock, but Peloton, so color me surprised they're still in business. I'm actually also kind of shocked this stock didn't close the year up, based on how the markets just pumped almost everything. So my prediction was right, but I have no right to gloat since this is my first W prediction, LMFAO. Next up, Carvana. Now this company can't do anything right in regards to car compliance, and coupled with falling prices in second-hand cars, this company will struggle. And there is already news that they are close to bankruptcy. I'll be surprised if they still exist by 2023 end. So essentially, Carvana doesn't even do all the proper legal work in terms of selling you a car. Like, they've sold unregistered cars to people, they've sold stolen cars to people, they've sold faulty cars to people. And in terms of the bankruptcy thing, two of their biggest creditors recently, I guess, like colluded together saying, hey, we think Carvana is going to go bankrupt. We're going to sort of reach some sort of agreement to get as much back as we can before they file for bankruptcy, because if we do this after they file for bankruptcy, it's going to be a lot more messy than it is right now. And in the last several days, at the time of recording this voiceover, I've noticed that Carvana has been one of the, I guess, worst moving stocks in my watch list consistently. So the writing is on the wall. The only reason this stock gets pumped is because of oversold technicals and the algorithms pick it up and shit like that. But yeah, I'd be very surprised if this company isn't bankrupt by the end of 2023. Carvana, what the fuck? I have no clue how this company survived bankruptcy, and somehow this company is smashing their earnings. So this is a big L for me. Yikes. Wall Street Millennial, one of my A-tier finance channels, actually made a video recently that goes over how Carvana was able to save itself through a restructure. But this restructuring of its debts is only a band-aid. It certainly won't take them back to all-time highs, but maybe it'll keep them afloat for a while longer until they turn other parts of their business around, if they ever do that. Although the boots on the ground experience I've seen from people dealing with Carvana tell me that, well, they didn't tell me specifically, they just told everyone, but the boots on the ground experience says that Carvana is such a shit company. Like, they do heaps of dodgy shit and they don't do anything right, so who knows, but I'm not going to make any predictions about it because who knows what it'll do in the next year. Next up, Blackstone, a real estate investment company, and they've recently frozen withdrawals, so there's something brewing. Why would you freeze withdrawals? My guess is that they were over-leveraged on the property market, and because property prices are falling everywhere, except in my region in Australia, they're running into some financial problems. So I don't know if they use leverage on this or anything, but from what I've seen, Blackstone isn't headed in the best direction. At the very least, they will drop throughout the year. Like maybe they'll be down halfway through the year. They could recover, but I think net they're going to close the year down. Blackstone, another bad call. However, the fact they had suspended withdrawals was accurate, and from what I've seen, they were slowly giving money back to investors. Like, if you owe 5 people $100 each, and after several months you give one of those people back $80, so you then tell everyone, hey, someone has gotten most of their money back. That's what Blackstone has done. And even so, they dodged a bullet as withdrawal requests have slumped, which is not something I could have predicted at the start of 2023. Last stock I've got for you is Play, which is Dave Buster's Entertainment or something like that. So what this is a bunch of restaurants and arcades around the United States. They've got a bucket load of locations. They had like 174 at some point. That was like the last time I properly had a look at them. I don't know if they've got more or less now, but with the recession coming up, people are going to be less likely to spend as much money. And unfortunately for them, arcades and restaurants aren't on the highest list of priorities when you're trying to save money. So I think that they're going to run into some hardship. Dave Buster's Entertainment? Eek! Another bad prediction. Turns out the American consumer is more resilient than I thought. Although from what I've seen, most of these people are putting purchases onto their credit cards, which are almost maxed out, also based on the data I've seen. But I'm just going to admit defeat. I'll capitulate. I'm a pussy bear, as the Maverick of Wall Street would say. Based on how this year has gone, it simply shows the market will tend to just brush off bad news. The downturn in 2022 was mainly due to a giant correction since we rallied so hard in 2020 and 2021. So there we have it. My predictions for 2023 were mostly wrong. In my defense, as I've already said, these were predictions I made at the start of the year based on the information I had at the time. A lot can change in a year, and I had good reasons for these predictions, but economic factors such as the government botching inflation data, market analysts downgrading earnings which causes the stocks to rally after they beat the low bar they were set, China's economy not doing anywhere near as well as expected, and the market shrugging off bad news and rallying were all factors that were hard to foresee 12 months ago. However, in my not defense, I was confident enough to make a video on this. So no dodging of accountability here, I'll own these bad takes. I may make a 2024 predictions video, it just depends. I have 3 videos in the works at the moment, including this one. If the other 2 take too long, then maybe I'll just ditch the 2024 predictions video, as I don't want that to come out too late after 2024 has begun, because then it just loses its sort of hype. We shall see. So actually, I've got a 4th video kinda in the works, and it's not specifically a 2024 stock market prediction video, it's more like 2024 and beyond sort of video. So it's not like specific to 2024, but for a lot of these stocks, it might be worth getting in next year anyway, so we'll see. We'll see whenever that gets uploaded. I do, however, have one prediction that will come to pass. I predict you and I will crush this upcoming year. Thanks for watching. That is all.